and then we'll move into working problems that are either end of chapter or supplementary problems, a little both. That should take us the better part of our 2 hours. So we'll see where that goes. You are being recorded as of less than a minute ago. When I get that back from Cisco, I will publish it almost immediately. Usually takes 1 to 3 hours, depending upon, I guess, how quickly their software handles it all. Okay. The grades were posted for the midterm over your, since we last met. I think I posted it about a week and a bit ago on a weekend. So you should be able to take a look at what your grades were. We have a session this afternoon at 2 o'clock, I believe it is. And it should only take us about an hour, maybe less, probably less. And at that point, I'm going to note a number of very common mistakes that were made by students. And secondly, I will speak to each of the answers related to the questions on the exam. So we'll step our way through those. In order to carry that out, it would be a good idea to have your own work with you at that time so that you can compare that to what my answer or answers were. In some cases, a problem could be approached by more than one method, and I often will work both methods out in my work for viewing purposes. At 1 o'clock today, you have a quiz. It's 25 minutes, my normal time on that, subject to exam accommodation, of course. And as far as our final goes, you should note that it will be 2 weeks today. I have yet to decide whether it'll be a morning or an afternoon exam. I'm thinking of an afternoon exam at 1 o'clock is what I'm thinking right now, but I'll confirm that in an email to all of you.
Hey, Wayne.
Yeah.
On the actual marks, it shows that there's 2 quizzes remaining after today's. Are you just cutting one out, or?
After today, I'll be cutting one of those 2 out, yes.
Okay.
Just the way things have jammed up. So we'll do quiz 4 today and quiz 5 next week.
Okay.
And I'll cut quiz 6. We're just not going to cover enough material to put that out there in front of you.
Okay.
So it doesn't seem fair. Is that what you want to hear, I guess, or what
yeah,
you?
That's good.
Yeah.
Thanks.
Okay. No problem at all. That way. So for all practical purposes, the course will end at the end of chapter 5, which we'll address next week in class and do a number of problems related to that. And it may be a longer session than normal. I want to make sure I cover some of the questions that are in there fairly well. And then, of course, the week after that's the exam. So I'm just looking at my notes here now. So you should be looking after today at chapter 5 on your own and preparing for that material, going through the material, and be familiar with, if you will, the material. And as I say, we'll review a number of questions related to that during our class next week, if everything goes well. So what I'd like to do today, I think that covers my key points on this. But what I'd like to do now is take a look at our end of chapter or supplementary problems. We have a few of each to do. So I'm going to start out with 4.8. Realize now that we're in the chapter where we're doing comparisons or examining various comparison methods. If the question that you're doing or on an exam that you're doing states the method that should be used, that must be used, then please adhere to that. If you answer it with a different method, it doesn't score at all. So be attentive to that it should be pretty apparent in the questions, in that I will stipulate that you must use present worth or present value, I could say, or annual worth or future worth to undertake this, unless the question itself, it's implicit in there that you would have to use a future value to get there. Okay, so 4.8, it's about a water system for irrigation purposes. And there's a little bit of preamble there that really has no impact on the question, that it's obtained from a nearby stream from the mountains. But they're looking at two alternatives. And the idea would be is which is the better financial arrangement when you're looking at more than one option. These would be mutually exclusive, of course, because you're only going to do one or the other. If you do one, the other one goes away. If you do the other one, the first one goes away. That makes them mutually exclusive between the two of them there. The first one is a concrete reservoir with a steel pipe system, and the second one is an earthen dam with a wooden aqueduct. So the costs are related in the table as a part of the question. So we'll take a look at that as a way of analyzing the information that we've been given. We have an 8% interest rate that would be applied. An operative word in the question that you should have picked up on by now is says that both of which have essentially infinite lives. So that's telling us that there's no n value given. N is infinity. So there's a special way of handling that in the chapter, and that's what we'll be pivoting around in this regard, using what's referred to as the capitalized value. So let's take a look at that here. EOC. I got to get my desktop up here. Just give me a minute, please, on the screen for you to view. So you should now see my grid paper on this, and we're dealing with EOC 4.8. Let me also activate my chat line on this page as well, so that if any questions come in, I can see what we're dealing with. Okay. So our first approach will be, and I'll just call it number one. There's two of them. It'd be the concrete. Concrete reservoir. And this one is pretty straightforward in that we will have a timeline associated with it, which I'll put right here. And it indicates there is an initial cost, and I'm taking this information from the table associated with the question. There's an initial cost here of $500,000. And there will also be associated with that an annual maintenance cost of $2,000. So not too much, but I'll show it this way. Again, try to pay attention as we're doing this to the way the various cash flow elements are being laid out on the cash flow diagram. I found, as I'll point out this afternoon, that some of the cash flow diagrams were just simply wrong, not even close, the way they were drawn in terms of the standard that's used in drawing these. So please recognize that. So here's your annuity. And they are of infinite, this is of infinite life. So it really goes to infinity if you like. So n has no value. And when n has no value, you need to turn your attention to the capitalized value, which is a present value or a present worth, if you like. So apart from the fact that we have an interest rate here of I is equal to 8%, it's implicit in this area that we're going to have to do our comparisons at the present worth value, simply because that is what the capitalized value gives us. To make it short here, the present worth of a project that has an infinite life is equal to the annuity divided by the interest rate. That's sort of the fundamental formula we're going to be using throughout this problem here. And the key here is to make sure that the annuity and the interest are in the same terms. And that is the case here, because this is $2,000 maintenance fee per year, and your interest is per year. So we have compatibility there. So this one will be pretty straightforward. So our present worth, and I'll use a subscript 1 here to indicate it's for the first option, which is the concrete reservoir. And it will be equal to, maybe before I say that, I'll point out that all we're given are cost here. We're not given any benefits. And that is permissible, as you probably have read now in this chapter. You can use this approach when the benefits are roughly the same, and when the benefits are, for all practical purposes, the same no matter which option you choose. So in essence, all the benefits, if you were to work it out otherwise, will cancel each other out when you're comparing the two projects. So there's no need to include them, and the question is not even set up that way because it does not speak to any benefits. So what we're going to be doing here is simply determining the present worth of the cost, not of the cost and benefits. Okay, so when you're doing that, and we have yet to get there, we'll come back to this point I'm going to make here. So we'll be looking at the project that has the least cost is the one to choose, not the most cost. If we were looking at the present worth of the whole project, we'd be looking at the one that has the greatest or the largest present worth. But when you remove the benefits from this formula, when you do that, you're left with cost. And when you're dealing with analyzing a project purely from a cost perspective, then you're looking for the least cost as your best choice amongst 2, or there could be 3 or 4 or 5 methods that are being considered here. In this case, just 2. So this will be equal to, and I'm going to use a minus sign here because it's in a bracket around it. So it's going to be equal to the first cost, which already is a present value. We don't have to do anything to that, plus the present worth, if you will, of the maintenance. So that in turn will be equal to minus, I'm going to carry the bracket here still. First cost is 500,000 plus the present worth of the maintenance. So we're looking at the present worth, present value of A over I. Now I could have left this as first cost in here. I didn't have to put it in there. It doesn't matter. Then the next step here would be minus cost here is 2,000 annual divided by the interest rate annual. Again, I know I'm stating this when it may not be necessary, but these two, the numerator and the denominator, in order to successfully divide that out, have to be in the same units. So what we'd have here would be doing that arithmetic, be minus 5,200, $525,000. So that's the cost, if you will, of that method. So that part's pretty straightforward. The next part, the earth and dam, though, gets a little more challenging. Not too much, but a little bit more. So we're going to do it, number 2 here. And it's the earth and dam. So once again, I'm going to draw this out here, and it's only costs are being shown. So we'll draw it here. And the infinity comes in. This is times 0. I could have put a 0 up here too, but times 0. And our initial cost in this case is 200,000. So it's a little cheaper to start with. However, there are two costs. There's an annual maintenance cost, but every 15 years on top of the annual maintenance cost, we're going to have to replace the wooden portion of the aqueduct for 100,000. So we're going to have two ongoing annuities into infinity. So the first one I'll just show here as and it is 12,000 per year. And the next one is going to look like this. And it is an annuity here at 100,000 per 15 years. So that adds another wrinkle. Otherwise, we'd be doing just what we did above for the first one. So in this case, the present worth of the second option that we have here, and I'll use a minus sign with brackets to encompass. That allows me to use the plus signs throughout. But when we end up on the last line, of course, when the brackets disappear, we have a minus. So it's going to be equal to minus bracket the first cost plus the present worth or present value of maintenance, which is this one here, plus the present worth, present value, I prefer that usually, of the replacement. I'm just going to call it that. I guess I could, a wooden portion replacement. I guess I could write that out. Wooden portion of replacement. And that would cover all of the costs we've been given. The difficulty we have here, though, is our interest, just like above, it'll be the same, of course. I will be equal to 8%. So for the first present value, we have no difficulty. We are going to have years and 8% per year. But that's going to be a problem here that we're going to have to solve along the way. So putting the numbers in here, I'm just going to write this one here, the present worth 2 minus, just going to leave this as first cost here, plus A over I plus A over I. Now, in order to not distinguish between these two, I'm just going to indicate here that I'll put this as a number 1 here and a number 2 here. So this will be A1 and A2, just to distinguish them and not lose track of which one I'm dealing with. And again, because n goes to infinity, these have an infinite life. So we're going to have to use the capitalized value approach to the solution of this. So we'll put some numbers in here. First cost on this one is 200,000. Plus A1, which is 12,000. Over the interest rate of 0.08 plus, and the difficult or the options we have here, I will choose one of the two, is that we either have to convert this 8% to a 15%, this 8% per year to X percent per 15 years. So we're going to have to gross it up. And you just can't multiply this by 15 and get it because it's compounded. So that would be one approach, and it's viable, it works. Another approach would be is to take the 15-year annuity and break it into an annual annuity. Then we would have per year for A2, and I would already be per year. So we do that simply by indicating that we have the $100,000, and that's how much it is per year. So we're going to have 100,000 here over the interest rate, but that's per 15 years. So what we're going to do then is treat that 100,000 as a future value and break it down into an annuity for each of the years, the 15 years leading up to it. So if we were to do that, we're going to have to multiply this number by what would be the annuity if we know that future value. We know I, 8%, and N in this case would be 15. Let me just AIN. I should use the N here. So this, by treating the 100,000 as a future amount, we can break it down into a 15-year annuity preceding it. And we do that through the what is the A if we know the future value I and N. So do this, minus bracket again, 200,000 here, plus I could leave this as is, or I could work it out and put it in. It won't matter. I'm going to leave it as it is. Plus 100,000 over 0.08. And that will be multiplied by what is A? We know F. I is 8%, and N is 15 years. So what I'm going to do one more time here is write this out, but I want to put my factor in there this time around. So 200,000 plus, and I can do it this way here. Got to find my calculator here. If we have 12,000 divided by 0.08 gives us 150,000. So we'll have 150,000 here plus 100,000 divided by 0.08. And the factor up here, when you look that up, AF 8% 15 years, we should get a factor of 0.03683. And when you do all of that arithmetic afterwards, you end up with a final cost, getting rid of these larger brackets at the end here. You're going to end up with $396,037.50. So as I mentioned at the beginning of this question, I'll back up a little bit here. This would be the present worth of option 2, but it's the present worth of the cost. There are no benefits to consider. So with that in mind, we're looking at these two numbers here, this one here and this one here, and we're saying we want to choose the one that has the least cost to the, is it an RM or whoever it is?
Hey, Wayne,
Yeah,
can you slide the page up? We can't see the bottom.
of course, and I do appreciate that.
Thank you.
There you go. I appreciate it. Yeah, I'll just give you a second there to catch up on a couple of the lines of the arithmetic there, if you like. So now that we have that, and I'll just slide it so we can see the other one here, but we have this as the present worth of the cost, and this is the present worth of the cost for options 1 and 2. So we're looking at the one that's the least cost. So we should choose the least cost. Option, i.e. number 2. This is cheaper than this one. Hence, the conclusion line, if asked for, would be essentially this, but the builders or whoever they are, it doesn't really say in there, I don't think. So the second option should be chosen because it is the least cost of the two options presented. And you'd be done that question. So the tricky part to this one is the conversion of this 100,000 annuity per 15 years and making it into what the annuity would be if we went for 1 year. And you do that by deeming any one of these payments of $100,000 to be a future value and determining what the annuity would be over the preceding 15 years. So you're using this routine in here, the factor statement, the numbers put into that statement, and then the factor itself. And that's how you would do that question. So with that done, I want to do the next one in that signed in the material that was presented to you. It's in Learn, but we're going to look at 4.9. Now 4.9, Margaret has a project with a $28,000 first cost that returns $5,000 per year over its 10-year life, has a salvage value at the end of 10 years. If MAR she is using is 15%, what is the annual worth of the project? So in this case, we're having to calculate the annual worth. There's where I tell you here, if you look at the question, it's clearly indicating that we must use the annual worth. It's asking for what is the annual worth. I'll make this point when we review the exam this afternoon, but I'll take the 30 seconds to put the point in here. Some people, when they were asked to do the annual worth and they had a future value, instead of converting the future value into an annual worth, they converted the future value into a present worth and then back to an annual worth, which takes longer to do because in essence, you're making what could be a one-step process into a two-step process. And secondly, you're introducing, and this did happen on the exam where this happened, mistakes were made in the arithmetic. It might not have happened if you'd gone directly from the future to the annuity rather than from the future to the present and then to the annuity, because you introduce that extra step. And in not all cases who did it this way, they still got the right answer, just took them extra time. But there was one or two people who did it that way and they messed up their arithmetic along the way. So that would cost you marks. So again, take the direct route. If you have to go from future to annuity, do it that way. Don't introduce and sort of a waypoint along the way, being back to the present and then to the annuity. So I'll just point that out. But I'll mention that again this afternoon or when we're reviewing the exam. That was I won't say a common mistake, but it did occur more than a couple of times. So 4.9, we have Margaret here in this case. And this one here seems to be pivoting around because this chapter introduced the concept of MAR. MAR stands for the minimal acceptable rate of return. So that is an interest rate. So her first cost in this case was $28,000. And in that process, she's going to sell it. She's going, sorry, not sell it. She's going to have a return on that. That's a receipt of $5,000 per year. That's what this piece of equipment is going to make her. So we have an annuity here. So we have $5,000 here. And in addition to that, it's going to be out of scale here a little bit, but I'm just going to try to keep it in scale here. She's going to have a $3,000 salvage value on it at the end. It will run for 10 years. This will be time 0. And that'll be a negative, a positive, and a positive. So what is the annual worth of this? Well, the annual worth, and again, this is telling you it's saying annual worth, so you must use the annual worth method. Don't compute a future value or a present value. That will not score marks. So what we're going to do here is the annual worth will be equal to the, we have to convert the present value or first cost to an annual worth as part of it. So we want the annual worth of the first cost we want the, just going to put these in as pluses, the annual worth of, call it the receipts, but in the question it was called a return, so the annual worth of the return plus the annual worth of the salvage, for lack of a better term. So those will be the 3 components, but we need them all as annual worth. So in this case, we have to convert this annual worth to a, we have to convert this first cost or a present cost into an annuity. So we'll do that by saying it's minus, signage is important, the present worth, or P for present value, present worth, onto what is the annuity. We know that present worth, the I and the N. Up here, I probably should write also that MAR, which is equal to I, which is equal to 15%. When you see a percentage like that, that's not compounded, so it's not nominal, so we can use it directly. And if it doesn't say to the otherwise, the default presumption we make is that it's per year. Even though the question doesn't explicitly say that, that is the default value for the interest rate would be per year. So on top of that, we're going to look at the annuity up here, the annual worth of the return. Well, it's going to be a positive because it's above the line. And it's already an annuity, so we don't have to do anything to that. So I could write the number in there, or I could write the annual worth of return. There's nothing I really have to do to that at this stage. Plus the annual worth of the salvage. Now that's a future value. That's 10 years down into the future. We want to convert it to an annuity over these 10 years so that all of these 3 terms are compatible. So to do that, we're going to have to put in our future value, F, and what is the annuity if we know the F, the I, and the N. So now we have the core line that we're working with here. So the annual worth will be equal to minus the present value, 28,000, onto AP. I is 8%, and N is 10. Plus the annual worth of the return. Well, that's already an annual worth, and we don't have to convert it to anything. We just work with it. So that's going to be 5,000. Plus the future value of 3,000 And what is the annuity? If we know the future value, I is 8%, and N again would be 10. So we're going to write this line one more time.
I is 15%, right?
28,000. And this factor here from the tables will be,
Hey, Wayne,
Yeah,
Yeah.
it's
we're using the
15%.
MAR
Wayne.
as our interest rate.
I'm sorry? Oh, 15. Yep, you're correct. I don't know where I got the 8 from, but thank you for pointing that out. Previous question, I think. It's a good pickup though, guys. So you want me to put a 15 in here and a 15 in here. And with those numbers, you should get here for this factor, 0.19925 plus 5,000 plus 3,000. And this factor here will be 0.04925. And when you do all of that arithmetic, and signage is important here, you should come up with minus $431.25. It's a minus though. So this falls below. She's not going to lose money, but she's not going to achieve her MAR, because at that 15%, she ends up with a loss. So in this case, Margaret would end up losing $431.25 per year for each of the 10 years. So that would not be a good investment for Margaret unless for some reason she opts to keep it, because she's going to make greater money on other tools that she will be using sort of in sequence with this particular tool. Now, I'm not going to work it out, but I'll leave it with you as an alternative approach. Because we have a first cost and a salvage, we could have used the capital recovery formula to solve this. The capital recovery formula basically combines together the first and third terms and treats them as one in using that. So as a practice, you should work this problem now on your own, not right now, but work it as as an alternative solution using the capitalized or capital recovery formula. You should end up within a penny or two of the same result, subject to sort of that round off area. Okay. So the next one I want to look at here is EOC 410, I think it is. So let's try EOC 410. Nabel, considering this sounds familiar, I think the difference here is that when we worked it before, we calculated the present worth. This question here, though, is asking us to calculate the annual worth of this initiative. So we should come to the same conclusion as we did it with the present worth. However, the numbers will be different because we're now looking at the cost of this initiative on an annual basis as opposed to a present worth initiative. So here, I'll draw this out here. this particular situation from as we did it before. Nabel is considering buying a house while he's at university. The house costs $200,000 today. Renting out part of the house and living in the balance for 5 years while he's at school. His net annual expenses will be $2,000 per year. So the expenses would be $2,000 per year. Sorry, I'm going to correct that. After expenses, it's going to be $2,000 per year. So that is what he's going to return. So when they use the word net, what they're talking about here is that you're going to have revenue and you're going to have cost. And the difference between the two is your net of the two. So I'm going to do it this way here. 0, 5 years. Initial cost here is $200,000. And just read the question here. Will net this here renting out part of the house and living in the rest over 5 years at school will net after expenses $200,000. So that's going to be his profit, if you will. So we're going to put that up here. And this will be $202,000 per year. MAR, which is an interest rate, is going to be 6%. And again, there's nothing saying otherwise. Oh, it's compounded monthly. So that's nominal. So we're going to have to convert that. So we'll come back to just whether we go to IS or IE on that. I subscript S, which is a subrate, or I subscript E, which is an effective rate for the year. Now, after all of that, he is going to, is it a he? Yeah, Nabel. He's going to have a return when he sells his house of $210,000. So I made one mistake here. I'm glad I picked it up. Right here, this should not have been per year. This should have been per month. Yeah, a couple of you already saw that, and that's good. Now, this is $2,000 per month. And our interest is compounded monthly. So we have to convert that. So if our net expenses are going to be, our net cost is going to be our profits, I guess I'll say, are going to be $2,000 per month. If we convert this compounded monthly into a sub period of months, then they will be compatible. So we're going to say here then that IS will be equal to R over M equal to 6% over 12 months in the year. And it is going to be 0.05 0.0, where am I here? Write it this way. I was going to write it in decimals, but I'll write it in percentages. 0.5, 1/2 of 1%. So 0.5. So now we have this at a monthly level per month. This is at per month. We can easily convert the years to months, and we have that compatibility. So N would be equal to 5 times 12 equal to 60. So that's the easier way to go. It is, you could work it with the effective interest rate, but if you do that, you're going to have to convert this annuity per month into an annuity per year, which again can be done, but it would require some additional steps. So what I'll do here then is start writing out our formulas. And the annual worth, that's what we're told to work with here. So the annual worth of this initiative will be equal to minus the annual worth of buying the house plus the annual worth of the net earnings, or I could say profit, the annual worth of the profit, plus the annual worth of the selling house. So those are the three components we have. Now in this case here, we have to convert it all to annual worth. That's where we're headed with this. Signage is important. So we're going to have minus. We would have here the present worth, present value. We're going to have to say what is the annuity. We know that, present worth, I and N. That'll help us to get that to a number here that's based on the annual worth. This here already is an annual worth, so I'm just going to write that down again. I could put the actual number in, it won't matter much. But I'll put it in here as just the statement, plus the annual worth of selling. So that would be a future value. We're saying what is the annual worth if we know that future value, I and N. So we'll go back a little bit here and put in some numbers. P is 200,000. A, P, I is 0.5% and N is 60. Plus the present worth of the profit, that's already a present worth, so it's going to be $2,000. Plus the future value, 210. What is the annuity? If we know that future value, I is 0.5%. And again, it's over 60 years, 60 months, sorry. Okay, we now will work this as a minus here. This be minus 200,000. And that factor will be 0.01933 plus 200,000 plus 210, 000. And that factor will be 0.01433. If we do all of that arithmetic, we should end up with $1,143.30 as a plus. So this is telling us that his MAR is 6%. He's going to achieve his MAR level. And in doing so, he is actually bringing in $1,143 profit per month under this arrangement, considering that his profit is $2,000 per month. He's going to get $210,000 back after 5 years, but initially he has to lay out this $200,000 to buy the house to begin with. So that would be a good deal for him. Since the annual worth is positive, Nabel should buy the house. It's going to make this a worthwhile venture. Okay. So again, what can I say about this? We could have worked it by converting this to an IE. If we did that, the effective interest rate, which is very doable, we would have precluded the use of the tables. Because your IE, perhaps you've picked this up already, IE will always be just a little bit more, not much, but a little bit more than your nominal. So if you go to IE, you're going to end up with 6.1 or 6.2% per year. And when you do that, you've precluded the possibility of using tables because you know you do not have a 6.2% table. All your tables, as you've now used these a number of times, pretty well should stand out. You know what tables you have. And just before you do any of the arithmetic, you know that if you take 6% divided by 12, you're going to end up with 0.5. You know you have a table. So at least at this stage, you have the possibility of using tables and not having to calculate the factor. So that's why I would choose IS over IE in this area here. Just more advantageous with possibilities. Really good. My only other concern is, does that same table, I equal to 0.5%, go to 60 for the end value? And it does. So in that case, just by looking at this number here and this number here, the tables are the IS is the best way to do it. And you should be able to do that pretty much in your head to say, gee, what do I do? Do I do IS or should I use IE? Well, IS works with the tables. That's going to be my path of quickest and simplest computations. So I'm going to do it that way. IE, yes, you could have left this at 5, but your IE value is going to be, and I don't have it in my head, I didn't work it out, but it'll be something like 6.1 or maybe 6.2 in that range. And again, you can't use tables, so now you have to calculate your factors all the way, which means you have to go back to prime formulas, put them in, put in the I values, the N values, and do all of the arithmetic associated with it when it's already available to you in the table. So that's the smart way to go. If you choose to do it that way, I won't mark you wrong. I will follow through what you did. But again, you run the risk of making an arithmetical mistake in doing it that way. And of course, then you start losing marks. Okay. So I want to take a look at the next one here. It's a supplementary for, find it here. I know I have it printed somewhere. Okay, we have a few problems here. We're going to do 4A to start with. So 4A will be right here. And it's in the supplementary problems, but in case you don't have it in front of you, here it is here, 4A. The Red River Construction Company is considering 2 investments to accumulate funds for a future project of equipment, future purchase of equipment, a gutter machine. Gutter machines are used to reshape metal for, say, rain gutters. As an example, you put in a flat sheet metal, for example, and it will shape it for a rain gutter. That's what that would be. But don't let that, if you're not familiar with what it is, don't let that bother you. It doesn't matter what it is. You could simply say it's a, I don't know, it's a lawnmower. Doesn't matter. It's the numbers that we're working with here. So don't get too hung up on if you don't know what the piece of equipment is. So here it is. I want to take a look at this, and we're saying here that they're taking a look at this. So it's a future value. So what we're looking for here, we have plan X. Plan X. We're doing a comparison here, and you're investing money. Often when you're investing money, most people like to compare that at a future value. And we'll do it for your options, plan X, plan Y, plan Z, plan T, if you had that many of them. And you'd be saying, well, what will I have in that account in 8 years is what the question asked for. So you're going to be doing a future value for 8 years down the road for 2 plans, and you logically would select the plan that gives you the most amount of money. So that is the primary time you will see a future value, although it can occur in any of the questions we've done. So let's take a look at this one. And I'll draw it out here. It's supplementary. For A, these questions are in Learn under the area titled, under the module titled Supplementary Problems. And in our first case here, we're going to start out by putting in the bank. So this is a cash layout. You're putting money into the hands of some investment company. It could be any number of investment companies. And it might be that as a company, you've got money and you could leave it in your bank account and earn a little bit of money on it, or you could invest it at a higher rate and get money that way. So what do we say this was here? It's 8 years. Time 0 is here. We're going to invest this here. You're going to have an initial investment, $12,000. And along the way, every year, you're going to put in another $3,000. Per year. So we want to know what is the future value. Use the future worth method for comparison. So again, I'll point that out to you. If you see a question like this on the exam that's doing a comparison, it will stipulate which method to use if it is not implicit in the question. So use the future worth method. So that's the method you must use. And as I say, that's fairly common when you're looking at investing money and you want to know how much will I have when it's run its course. And I have 2, 3, 4 options to look at. In this case, just 2. So what we want to do here is take a look at this. It's 12,000 here, 3,000 per year. The I value is 5%. It's not compounded, so it is per year. It's default, if you will. So all of these numbers work out pretty straightforward for this one. So the future value will be equal to the present value. What is the future value? If I know P, I know I, and I know N. This will be 5%. I know I have a table at 5%, and I know that in that table, N will equal, there's a value for N at 8 years. So tables will work. I'm going to use them. But I now also have to look into this other scenario where I have an annuity. So I have to take the annuity and convert it into a future value. So what is the future value again? I know A, I, and N. And those are the only 2 components that we have to be concerned with. So the present value here is 12,000. What is F? I know P, I is 5%. And N is, this is per year, that's per year. So it's 8 plus the annuity, which is $3,000. What is F? I know A, I is 5%, and N is 8. So one more time, 12,000 here. I need to look that factor up, and I'm going to find 1.4775 plus 3,000, 9.5491. And when I do that arithmetic, I end up with $46,377.30. Oh, excuse me. But that's plan X. Let's look at plan Y. Probably have a similar timeline, of course, or you'd have to make adjustments. And that part of the material in chapter 4, I am not going to examine you on, so we won't worry about it. In this case, we have no initial down payment here from this question, or initial contribution, maybe I could say, of an initial disbursement, but we do have an annuity that's going to run. Again, setting my times up here. We know this is 8 years. We know time 0 is here. And we know this is $4,800 per year. I will be same as before, 5%. And again, a couple of people doing a similar problem like this on the exam combine these 2 into one cash flow diagram. These are 2 separate opportunities. Each has to stand alone. So don't build one cash flow diagram on top of another one. They stand alone and are a separate item. So in this case, we know all we have to do is convert this annuity into a future value. So the future value will be equal to the annuity under what is F. I know A, I, and N. We know this is $4,800 onto F, A. %, in 8 years, which will be 4,800. The factor here is 9.5491. And if we do all of that, we end up with $45,835.68. So the question is, which of the two, something like this, questions like this, it's a comparison question. So I would ask for a closing statement, a concluding statement, or a decision statement. I like the word decision. The decision would be Plan X is the better choice because it returns after 8 years the greater amount of money. 46,000 versus and more, 45,000 and more. So there'd be a $500, is that what it is here roughly? Looks like that $550 roughly difference between the two by choosing Plan A over Plan X over Plan Y. So again, that would be the concluding. They fall in, they're not really negative. I would not mark you wrong if you did this in the positive or the negative. The money is still in the bank, and I try to make that, and you may even pick that up on the exam, as to where you leave the money. So sorry. If you call this a negative and a negative, considering it's still in the bank, you would still choose this one. But I would look at it in the positive fashion, and I would probably state in something like this that the money would come out of the account at that, you'd redeem it, if you will, at the end of 8 years. So it becomes a positive number. But I think that type of question is kind of ambiguous as to, is it going to be a plus or a negative? As long as you're consistent through both, I'll mark a plus or a minus number the same way. You're looking for the greater amount. That's what you're looking for. But do keep in mind that in both cases, the money is leaving you. It's going to the bank or to a financial company or to a credit union. They're using that money, and after the 8 years, they will return that money to you as a positive. So although strictly speaking, these would be seen as negatives, but I won't mark them wrong if it's a positive. I won't mark anybody wrong if it's a positive. I would be careful. There was a question, I don't know if it came to me. It came to me privately, so I won't use a name, but the question was, we could also use the Excel sheet from our assignment. And that is true, providing you have the right formulas in your Excel sheet. So what I would suggest you do is you do not use Excel spreadsheet to determine what your factor would be when you don't have the table values in front of you. You should use the table values, directly. And then if they're not there, you should use the prime formulas to calculate the workout. I would not recommend using using that value. I will pick up on it immediately because I know I know the ones that are not in there. I will know, given an I and an N, I will know if you're using the spreadsheet. So to be crystal clear, it wouldn't hurt, and I've noticed some of you did that before, is that you told me where it came from. You put it in there from the tables, and that's a good practice to do. Okay, that takes care of that one. And I'm not sure of our time here. I think we're okay in terms of what I want to accomplish here today. But I'm going to move on to supplementary problem 4B and 4C as well to make sure we get that covered. Now 4B is here. And it says, Wayne, I guess that's me, is considering two independent investment opportunities as shown in the accompanying table. What is the payback period for each? If he requires a 3-year payback period, which opportunity should he purchase? So we're buying machine A, or we could buy machine A and we could buy machine B. So if you look at that, that's a formula. What we have here is quite straightforward, I guess you could say, but this is a payback period. Payback periods don't use interest. And generally you're looking for a payback that's of a short term into the future. You also do not take into account with a payback period. And it's implicit you have to use that. It's saying here, if he uses a 3-year payback period, so you're going to be using the payback period method. It does not consider interest along the way, and it will not consider a salvage value into the future. You're just simply saying it. You're looking at your first cost and how long will it take it to come back. So I'm going to draw that out here. I'll draw it roughly, a little quicker maybe. This, it's 5 years. I'm taking this from the table, if you will. Tables are here. So the first cost for machine A is here at 15,000. Still need a cash flow diagram. The annual revenue is going to be $9,000 per year. It's annual. And there are annual costs associated with it at $6,000. Per year. And there's a scrap value when it's all said and done at 1,000. So it's not going to be that high, but I'll just exaggerate a little bit here, put it in here at $1,000. Now for a payback period, that's fluff. It has no meaning because you do not consider salvage values when you're using the payback period method. Okay, so we have it that way. And the formula is pretty simple. I'll use PP for payback period. There's no abbreviation like that in the textbook, but just to save it, and if you want to use PP for payback period, that's fine with me. Or you can write it out, doesn't matter. And it's equal to the first cost divided by the annual savings. So putting that into a formula here, we're going to have 15,000 over annual savings. What are your annual savings? Well, you have to be a little careful here because you have your annual savings. In other words, what's your profit? It's going to be 9,000 minus 6,000. That will be 5 years. So it's going to take you 5 years then under this configuration to pay off your initial investment. Again, I know I'm repeating myself, but in that case, in the case of payback periods, you ignore interest. Interest is not a part of the formula. And secondly, you have no interest at all in the salvage. It's just excluded from the computations. So that there is for machine A. I'll just label that here A. But this is a comparison question though. There's another opportunity here. And the payback period here is similar. So I'm going to draw this here. It's 10 years in this case is your payback. And at that time, it will be $2,000 salvage value. Your savings, what you earn, will be 11,000, but you have expenses of 8,000. And you have an initial investment of 20,000. So your payback period in this case will be equal to your first cost divided by your annual savings. That will be 15,000. Sorry, my mistake. 20,000. Over your annual savings, well, you had expenses and you had returns on it. That's going to be 11,000 minus 8,000. And when you do that arithmetic, you should end up with 6.7 years. Companies tend to use this method. Some use it and just that's what they do. That's all they worry about. And they are looking for a payback period of shortest possibilities. So in this case, if these were the two machines A and B doing the same sort of work, if you will, you would choose A if it asks for a concluding statement or a decision statement because the payback period is less than at 5 years than for B, which is at 6.7. So you'd get your return, you'd pay for it, and after 5 years, you'd be making profit, if you will, from it. So that gives you your payback period. That's the amount of time it takes to offset the initial cost is what it boils down to. So in that case, you'd have that. And I just wanted to write this as supplementary. For B. Okay, on that one. Now this next one's a little interesting in that I want to do 4C as well. Okay, in this case here, it is again, as you'll see, it's a payback period in years and months. So we're being asked that. MAR is at 12%, but in the ones that we're doing, interest is not a factor. So we're going to exclude that. So let's calculate the payback period. Now, the formulas we used the first time around is when there is a constant profit or annual saving per year, and we can use this method here. But if it is not constant, in other words, as the years go by, your cost and your returns are changing, not constant. So your revenues are changing and your expenses are changing. If that's the case, you cannot use this simple, straightforward approach. And the method that's talked about in the book when that happens, and I'll explain it when we get there, but first, maybe before we do that, we should just draw our cash flow diagram on that. And that cash flow diagram will look something like this. You're going to have a timeline here, and it's going to go for, let me just see what it says in the question here. $10 years it seems to go for. Has a salvage value of $3,000 at the end of 10 years. In the first year, revenues are 10,000. So revenues are a receipt. It's 10,000 per year. And expenses are 2,000 per year. Okay. But then it goes on to say that the revenues and the expenses will increase by 10% and 5% respectively over the previous year. So this is not an annual event. This is going to be something that will look like this and like this. They start to look like a geometrical gradient. But again, because we're not dealing with interest in this sort of question, what we will do here is indicate, I can still call this the gradient here for this is 10%, and the gradient for here is equal to 5%. I can still put them on the cash flow diagram and should put it on the cash flow diagram. The way to handle this type of question when we're dealing with the payback period is actually set up a bit of a register as to how the money will flow. So what I'm going to do here in this case is to indicate in a register of cost here, I'm going to show year. Then I'm going to put revenue. Show expenses. And a balance. So what I'm going to do is step through this year by year by year because these values are going to be changing every year. It's not like the first two that we just finished doing here. Those ones, it was constant. So when you have a constant revenue minus expense, we can take that shortcut method that I just showed you there, where we simply divide the first cost by the annual savings or the profit per year. But in this case, that's not the case because these numbers are going to be changing. So what I'm going to do here for year 1, then I'm going to year 2, 3, 4, 5, and 6. And we don't know where it's going to end up here. It could be 7, 6, 7, 8. It's just going to come down that way. Now the revenue in the first year at day 1, there is no revenue. There is no expense, but your balance is minus $28,000. And I should have put that on the cash flow diagram as well. Okay. Now in the second year, we're told, or at the end of the first year, we're told that the revenue was $10,000. Just want to correct that maybe. We're told that the revenue was $10,000 and that the expenses were $2,000. That comes directly from the diagram here. And what we could say then is that the next value here will be 28,000 minus 28,000 plus 10 minus 2. Revenues are pluses, expenses are negative. If we do that, we end up here with an $20,000 balance. Minus 28 plus 10 minus 2. These are thousands, so maybe I'll reread that. 20 minus 28,000 plus 10,000 minus 2,000, which really means you have a gain of 8,000. So minus 28 becomes minus 20. So at the end of the first year, it's not paid for itself yet. Still have an outstanding negative balance. So we'll try the next one. Now, the next one though is a little different because the revenue has grown by 10%. And if the revenue is growing by 10% in this year, it's going to be 11,000. And the expenses are growing by 5%. So it's going to be 2,100. So minus 20,000 plus 11,000 minus 2,100. That should now give us a value of minus $11,100. So we still have a negative in there. It's not growing any bigger. It's not paid for yet. So we have to go another year. In this case, we're going to have to add on another 10% to this number. So it will become 12,100. And in this case, we're going to have to add on another 5% to this, which will make it into $2,205. So if we take a look at that, minus 11,100 plus 12,100 minus 2,205 should give us now a new balance of minus $1,205. Okay. Still not paid for. We still have a balance at the end of the third year. We still have a balance of $1,200 roughly. So we got to do one more year. So we got to add 10% to this because that's our rate of increase in that. It's going to now be $13,310 by adding 10% to it again. Over here we add 5%, It's going to be 2,315 and 25 cents. So we have minus $1,205 plus $13,310 minus $2,315.25. So that now tells us we are in a plus $9,789.75. Okay. So we know that the return, the break-even point is somewhere between years 3 and 4, much closer to 3 than 4. So we would use linear interpolation to resolve that problem, to resolve that, if you will. And you can look at this in a couple of ways. You would be allowed to use linear interpolation to do this. So it doesn't have to go beyond, these are no longer an issue, because we don't have to go down there. We've already broken even and we're making money from this piece of equipment. So we could set up a linear interpolation in order to conclude what it would be. And I would do it this way. The linear interpolation, I would draw a little graph here. Where would I do that? I'll try it here. And I'm going to put it here because I know I'm going to have a negative number in here. So I'm going to put my line here. And I'm saying here that for X1, year 3, I know that there will be a minus number here. So I'm going to put it here. I'm jamming my work in here, unfortunately. This is a minus. This will be Y1, and it's going to be equal to minus $1,205. Year 4 is over here. So that'll be X2. It's a positive number. This here will be Y2, the corresponding number, and its value will be from the table here, $9,789.
Excuse me.
Yeah.
Could you move your paper up a bit?
You bet. Yeah. I apologize. I'm not looking, I've said it before, but I'm not watching my screen. I'm just working on the paper, so I don't realize I'm sliding off. So again, it's just a linear interpolation, but with a minus. So it's a little different that way. This is a positive up here. And we're simply from that. This will be the 0 line. And what we want to know is what is the break-even point? So Y0. And that will be here at X0. So we want to compute what, or they call it star, I guess, to keep it straight in using the formulas in the book. So Y star is at the break-even point in this case, and here is what we're looking for. Where along this line is it? This is for year 4 here. So we have years this way, and our balance is on this line. I'll maybe write that here. Okay, so I'm going to use the formula here that we have. X star will be equal to X1 plus X2 minus X1 onto Y star minus Y1, I2 minus Y1. So if we put numbers in here, we're going to have 3 and the corresponding plus 4 minus 3 onto Y star is 0 minus Y1. I'm going to put a bracket in here because it's a minus number, which will turn it into a positive, of course, but it's going to be 1205 over Y2, which is 9,789 and 75 cents, minus Y1, which is, again, I'm going to use a minus because it's, or use a bracket because it's a minus, 1205. And when I do that arithmetic, and don't lose track of this, these are minus, this is a minus here and a minus there. So these are going to become pluses. We're going to end up here that X star is equal to 3.11 years. So that would be equal to 3 years, comma, 1.3 months. Now, if we're working with months as to how we return the money to us, that in turn could be stated as 3 years and 2 months for an answer here. The only reason we make this maneuver here from 1.3 months to 2 months is that the books are kept at a monthly level. So I normally don't go into that sort of detail, but it's possible. I just sort of look for this here. 3.11 years are your break-even point. If the books were kept at an annual level, then this would become a 4. Because again, your expenses and your revenues do not materialize until the end of a year if they're kept at the year level. Normally that would not be the case. Most of the time they're kept at a month level. So you have to get your years out of there, end up with how many months are left over, and then move it up to the even number of months or to the next level of months. So that's what we have there. So those are two or three, I guess, problems where we dealt with where we've dealt with payback period. So you can, I think in fairness, I can indicate that it's a good probability you would end up with a question of that nature because we've never done it before. These are new chapters and payback period was not part of your first go around. The exam itself, I'll indicate, is the exam itself will be for 2 hours as before. As I've already mentioned, it'll be, I'm not sure how many questions will be on it. I have to look at how difficult or how long each question is, but you can expect about something similar to what you had at the midterm. And we'll go over that this afternoon. And yeah, I don't know if there's anything else. There were 10 to the hour, so I'm not going to go on to another question because we're not going to be able to finish it in the 2 hour, in the 10 minutes left. So we'll let that be. Okay. Let me just pick up on your question here. Yeah, I could have shown that on here. Fabian's pointed that out. But again, salvage value becomes, is there a salvage value in here? $3,000 return here. You could put that on here as your salvage value. But it, again, in using payback period, it's not relevant. It's a quick and dirty solution, as it says in the textbook. It is a sort of things some companies use. Maybe they're looking at maybe, I don't know, 10 options to buy some sort of which is the better deal of a front end loader. Just throwing that out there. And they might use the payback period to remove a few of the options initially, and then do a greater detail by either present worth, future worth, or not likely future worth, but they could, or annual worth on the remaining, say, 3 options to cut down the amount of work. So you kind of use it as a preliminary way, or a way to, in a preliminary sense, exclude a few of the options if you have a number of them to work with. Some companies will do that. And then they'll say, now using the present worth or the annual worth method, which of the remaining 3 out of 10 would we go with? So they can use it as a filter. I think that's the word they actually use in the book, a filter to remove some of the options that you're considering, and then just deal with the remaining ones. In other cases, there are companies that just simply use this method. That's all there is to it. They'll look at their 3 or 4 or 10 options. They'll do a payback on it, a payback method on it. And the one that returns the cost, the initial cost, the earliest is the one they'll go with. So till you start working for a company and being asked to do this, you really don't know what method they like. More and more companies are using sort of the full-blown present value method, the annual worth method, or even a future worth method, although that tends to be limited to investment of money into a bank account or a financial company. So that'll give you that insight there. I'll leave this here. So I don't have anything else to add for today. We do meet next week, and we will do a few problems out of chapter 5 as well. It uses linear interpolation. So that type of problem is the sort that we will focus on, if you will. In other words, what's happening in chapter 5 is that we do not know the I. So we're going to do a comparison using what's called the internal rate of return. Now, the chapter itself also speaks to an external rate of return, but you do not need to be aware of the external method, the external rate of return. In previous years, due to time and the limited amount of lectures we have, I've never gone into the external rate of return method. So when you're reading chapter 12, when you're reading chapter 5, just deal with the internal rate of return information. Don't worry about the external rate. Okay, I just wanted to leave that with you in closing here. Okay, I'll stay on here as you guys close out, and see what's left. I'm going to take off, and I'm going to stop recording now.
Hey, Wayne.
Yeah.
Yeah, just to verify what you were saying before. So all that's left is the final. That's at 1 p.m. and the quiz next week at 1 p.m. And then obviously the one today.
Yes, that should be the summation of them. There'll be another assignment that comes out that I hope to get out within the day or two.
Oh, there is?
Yeah, I want to have 2 assignments.
Okay.
Yeah, I've already selected the one I want to use. I have a few that I can use. I just haven't put it together and kind of updated it with due dates and things like that. But there'll be one more assignment to work on as well. So I can't leave that hanging.
Okay, sounds good. Thank you.
Thank you.
Yeah, have a good day.
You too. Take care. Okay, I'm still showing 6 people here. I'm not sure if you're actually at your computer or not, but what I'll do here is close out unless someone has a question and wants to ask it at this moment. Give you a second or two to come online. Otherwise, I'll just shut everybody out.